Hello everyone to another video for CFA Level. In today's video, we will be starting with a fresh and a new topic by the name of Portfolio Risk and Return Part 2. In the previous video, we have completed a Portfolio Risk and Return Part 1. It was a 5 to 6 video chapter, right, where we have in-depth covered all the concepts, and I hope you would have understood seeing those videos. Now today we will start afresh with part 2. This is a bit of advanced level of part 1 and building of the concepts which we have studied over here. So what we will do primarily in part 2 is that we will divide risk and look at a risk from a more critical lens. In part 1 we have just understand the total risk as a perspective and understood the returns with respect to risk. In this chapter, what we will do is that we will break risk into various parts, deep dive into the risk, understand the crux of risk, and also the various return models associated with the different types of risk. So earlier we have understood overall measures of risk and return. Over here we will deep dive into risk and understand how different return measures depend upon the different types of risk. Okay. So, without any further ado, we will start. The first topic that we will understand is the capital market line. So, if you will remember, we have done something by the name of capital allocation line. Okay. In part 1, capital market line is a continuation to that. Let us study what it is saying. What is capital market line? Capital market line is a specific case of capital allocation line where the risky portfolio is the market portfolio. Okay, so what is a CAL? We studied about the CAL, guys. We have studied about the CAL. In capital market line, the risky portfolio that we are talking about. In the capital market line, the risky portfolio that we were talking about, if you remember the packet B, which we have told, which consists of packet A and the risk-free asset, that packet A, if you remember when we were talking about capital allocation line, which had packet A and the risk-free asset, and that packet A in the capital market line is the market portfolio. What is, now you will ask a very pertinent question. What is a market portfolio? A market portfolio is an imaginary portfolio. A market portfolio is an imaginary portfolio consisting all the stocks that are available in the market. Okay. So if the market has 500 stocks, then we will assume that this portfolio has 500 stocks. If the market has 50,000 stocks, then we will assume that this portfolio has 50,000 stocks. That is why we are saying an imaginary portfolio. So capital market line is nothing, a capital allocation line. Okay. The only thing is that the risky portfolio is now replaced with a market portfolio. Okay. Under the homogeneous expectation, we all know what is a homogeneous expectation. We have read it in part 1. Homogeneous expectation means the expectation that I have as an investor with respect to risk and return, you are also having the same expectation. Under the homogeneous expectation, the optimal CAL for an investor is termed as CML. Okay. The equation. Now we have seen the capital market line. Now what we will see is the equation. Every line, okay, every line has an equation. So capital market line also has an equation. What is the equation? It is given as ERP is equals to RF plus ERM minus RF divided by sigma M into sigma P. What is? Let us understand. ERP is the expected return of portfolio. Okay. What is expected return of portfolio? It is saying expected return of the portfolio is equals to risk-free return plus expected return of the market portfolio, expected return of the market portfolio, expected return of the market minus risk-free return divided by the market risk into portfolio risk. Okay. Now let us understand this equation in a more better manner so that we are able to develop on the concept. Okay. See what we were saying. Capital market line. What is a capital market line? It is nothing but a capital allocation line with a risk-free, with a market risky portfolio. So over here we have the market portfolio. Okay. This is the risk-free asset. We all know market risky portfolio will have a risk shown as sigma m, correct? So what is sigma? Sigma is the standard deviation, and it will have the return as ERM. Okay. On the other hand, risk-free asset, what will be the risk of a risk-free asset? See, the risk of a risk-free asset will be nil. Why will it be nil? Since it is nil, we are calling it a risk-free asset, so there is no denotation. On the other hand, the return is the expected return is RF. Okay. Given that we have these measures, what the capital market line equation is saying us is that we need to determine the expected return of the portfolio. So basically, we have to determine the expected return of this portfolio. Now let us understand the logical derivation behind that formula. See, you need to understand. Okay. We all know risk-free asset, there is no risk and thus the returns will be limited. Guys, yes or no? We are all aware about the fact. Expected return we have to find out. Where we are aware about the risk, sigma p. How do we find the risk? We have the formula for portfolio risk. Portfolio variance formula is, we are aware about it. Guys, yes or no? We are aware about the portfolio variance formula. Okay. See, you need to understand. If we talk about the risk, okay, guys, if we talk about, okay, see, if we consider this to be a return line, okay, since there is no risk involved in a risk-free asset, the RF will be this, okay. Since there is a risk involved in the market portfolio, the return from the market will be this, okay. We are aware about the risk of risk-free security and the risk of the market. Sorry, and the risk of the market. At the same time, we are aware about the risk of the portfolio. Now, the risk of the portfolio can be over here as well, or can be here as well. What does it mean? It means that the risk of the portfolio can either be more or can either be less. Guys, the risk of the portfolio can either be more or either be less. Correct? But considering the capital market line where we have market portfolio combined with the risk-free asset, the risk of the total portfolio will be lower. Why? Because we have all seen that risk-free asset, the risk is zero. So when we are combining it with the market portfolio, the total overall risk will be lower. So we rule out this situation. Correct? We rule out this situation. This is not possible. Guys, are we getting clear? Not possible. Since we are weighing market portfolio with a risk-free asset. Guys, are we clear? So the only possible alternative for the return of the portfolio will be here. RP is something which we don't know. Okay, RP is something which we need to calculate. Now, how do we calculate it? What is a formula to calculate it? See, what we are doing is a simple unitary method that we are applying. Okay, if we start from here, if this is the start point, okay, in order to arrive at the return of the portfolio, we will have to cross the risk-free return. Okay, so RP will always be greater than RF. So can we say RP is nothing but RF plus something? Correct. Can we say if RP is always greater than RF, then RP is nothing but RF plus something? See over here, when we are moving from the start point to RP, RF is in between. So can we say RF plus something in between? Now what is that something in between? See, this something we need to understand. What we have assumed in our risk and return chapter, that returns have a normal distribution, right? The returns are usually moving with the risk, which means higher the risk, higher the return, higher return, correct? Which means higher risk, higher return. Now, when we are talking about something, we don't know the journey from the starting point to RP, correct? But we know the journey from starting point to RF, as well as we are aware about the journey of starting point to RM. Are we aware? We are aware about the journey from starting point to RF. At the same time, we are aware about the journey of starting point to RM. We have to find out the journey of starting point to RP. Okay. In that, we have broken down into two parts, till RF and after RF. Till RF, we have done. After RF, we have to compute. So, can we say, based on this, that we are aware about the journey from RF to RM? We are aware about this journey, guys. Are we aware about this journey? Because we are aware about this journey and we are aware about this journey, so can we say we are also aware about the journey from RF to RM? Yes. And can we say RP is a term in between? Okay. We will write that down. We will do RM minus RF. What is this? This is the journey. Okay. In order to cover this journey, how much risk I am taking? See, you need to understand over here. When I am moving from the start point to RF, the risk that I am taking is zero. Risk is zero, correct? Are we clear? That is why it's a risk-free asset. But when I am moving from RF to RM, the risk that I am taking is sigma m. So can I say when I am moving from RF to RM, the risk that I am taking is sigma m? Okay. So basically, in order to move from RF to RM, I am taking a risk of sigma m. But if suppose I have a drop, or suppose I have a stoppage at some point in between RF and RM by the name of sigma p. Okay. Can I say if I stop till sigma p, what I will be getting is RP? What I will be getting is a journey from RF to RP. So, this is the journey from RF to RM. Okay, this is the journey, guys. Hear me out. This is the journey from RF to RM. Okay. If I say that if I stop at the junction, if I stop at the junction of sigma p, can I say I will have the journey from RF to sigma p? Or can I say I have achieved the journey from RF to RP. This is the journey from RF to RM. Okay, and we needed a fuel of sigma m. Guys, this is a very conceptual discussion we are doing. We were traveling from RF to RM and the fuel we needed is sigma m. Now suppose we don't have sigma m fuel but we have sigma p. So can we say the journey that we will travel is from RF to RP? Okay. So RF to RP is the journey we have already done. We have already done the journey from 0 to RF. If we add it, can we say the journey that we cover is from 0 to RP? That is what we are doing over here. That is why RP is equals to RF. RF is nothing but the journey from 0 to RF plus we are starting the journey from RF and we are trying to stop at the station of RP. This is the journey from RF to RM. This is the journey from RF to RM, guys. This is the journey from RF to RF, RM to RF to RM, and we are stopping at the destination of RP. That is why what the final formula that we are saying is that expected return of the portfolio is nothing but risk-free return plus RM minus RF by sigma m into sigma p. Guys, are we clear? This is nothing. This is the first station and this is the middle station. Guys, are we clear? This is nothing but solved through the unitary method. Nothing but simple application. Simple application of unitary method. Guys, are we clear? Guys, are we clear? Okay. Now we come to a very small topic, very easy. What is active versus passive investment? What is passive investment? Passive investment means when the investor believes that markets are informationally efficient, often follows passive investment strategy. Investors believe when the assets are mispriced, they follow an active investment strategy. What is a passive investment strategy? What is an active investment strategy? In a passive investment strategy, an investor will invest in the market portfolio and leave it as it is. Let me repeat it again. What is a passive investment strategy? In a passive investment strategy, investor will invest in a market portfolio and leave it as it is and trust the prices which are prevailing in the market are correct depiction of the real value and let it go as it is. Okay. In case of active investment, an investor will actively buy and sell securities. So, for example, today I'm buying 2 stocks of A. Tomorrow I'm buying 2 stocks of B. On the third day I'm selling 1 stock of A. On the fourth day I'm buying 5 stocks of C. Okay. So I am thinking that based on my understanding of the mispricing in the market, I can attain a greater return from the market. On the other hand, passive investors are those, though they will simply invest in the market portfolio and sleep. Are we clear? Guys, are we clear? Great. So what we will do today, we will keep the class at this point. I hope you have understood the capital market line and how do we derive and get the expected return for the portfolio. In the next class, we will do the risk deep dive. It will be a very conceptual and a very nice class. So kindly stay tuned to my class. Until then, happy studying.